The development of China over the past 2 years has widely been regarded as an economic miracle. In the 1980s, they were a poor agricultural nation and the vast majority of people lived in extreme poverty. Just 40 years later, China turned into the world's second largest economy with cutting-edge industrial and technological sectors. From 2000 through 2020, the Chinese economy has grown at a compound annual rate of roughly 14%, which is almost unheard of for a country of that size. With all that growth, you would think that Chinese companies would see booming profits and their share prices should be soaring. But this is not the case. During the same period, the Shanghai Composite Index has grown a measly 3.7% per year. The US economy has grown at an annual compounded rate of 3.5%, which is less than half of China's growth rate. But despite this, the S&P 500 has returned roughly 8% per year since 2000, which is massively outperforming the Chinese stock market. I'm sure you've all seen memes over the past year about how the stock market is not the economy. Most of these memes refer to the fact that the US stock market was booming at the same time the pandemic shut most of the economy down. In China, it's been somewhat of the opposite. The economy has experienced a historic boom over the past 2 decades, while at the same time the stock market has largely stagnated. In this video, we'll delve into the 3 main reasons this is the case. The first reason is that much of China's stock market is composed of inefficient state-owned enterprises, which do not maximize shareholder returns. Secondly, fraud is quite prevalent among US-listed Chinese companies. Thirdly, US-listed Chinese stocks are structured as variable interest entities or VEIs. The VEI structure is technically illegal under Chinese law, and the government could theoretically do a rug pull and render all US-listed Chinese stocks worthless. The VEI is somewhat complicated, but we'll go over it in simple terms later on in the video. A significant portion of China's stock market consists of state-owned enterprises or SEOs. They are mostly in capital-intensive industries such as banking, telecommunications, or industrial production. The SEOs are majority controlled by the government, but they IPO 10 to 25% of the outstanding shares to raise money. The SEOs have cheap valuations. For example, the Bank of China has a price-to-earnings ratio of less than 5. But despite the cheap valuation, the stocks of the SEOs are usually stagnant and drag down the performance of the rest of the index. Because the government controls the SEOs, they usually end up spending most, if not all of the profits, on new investments that are good for society or the economy as a whole, but detrimental for shareholder value. Take the example of a private telecom company like Verizon. If they have excess profits, they would likely use this to increase their dividend or buy back shares. This will boost shareholder returns. On the other hand, if China Telecom has excess profits, they would spend this on new investments into the economy, such as rural cell phone service or rural broadband. The new investments are often money-losing, but the government wants to fund them anyway because they have positive economic or social externalities. These projects burn a lot of cash and decrease shareholder returns. The second reason for China's low stock market returns is fraud. Fraud is not unique to China by any means. It happens in just about every country in the world. But China has been especially prone to fraud over the past few decades. Part of this is because many Chinese companies are listed on US exchanges, and the free float is held almost entirely by US investors. The US is home to the world's largest institutional investors, many of whom can only invest in US-listed companies. Because there is so much more capital available, companies can achieve a higher valuation on the New York Stock Exchange compared to Shanghai or Hong Kong. A 2008 study by the US Federal Reserve found that Chinese companies received a 21% premium when they listed their shares on New York compared to if they listed them in China. The valuation premium makes it very attractive for a Chinese company to list in the US. Currently, there are about 250 Chinese companies on major US exchanges, with an aggregate market capitalization of $1.5 trillion. When most of a company's shares are owned by US investors, the Chinese government doesn't really care if there's a financial fraud going on. If there is a fraud, it'll be US investors holding the bag, not Chinese. For example, Luckin Coffee IPO'd on the Nasdaq in 2019, and they achieved a market capitalization of more than $12 billion at the peak. They raised hundreds of millions of dollars almost exclusively from American investors. Despite Luckin being a China-based company, very few Chinese investors owned any shares. China has strict currency controls, which makes it very difficult for people to exchange their Chinese yuan for US dollars. This makes it difficult for Chinese residents to own any US-listed stocks, including Luckin Coffee. For this reason, the Chinese regulatory authorities don't expend a lot of effort investigating companies that are listed in the US. And to make matters worse, they also banned the US Public Company Accounting Oversight Board from conducting audits of China-based companies. With the Chinese government uninterested in auditing these companies, and the US government not allowed to audit them, it has become the financial equivalent of the Wild West. If you were a businessman in China who wanted to make some quick money, the easiest way to do this is to create a fraudulent company and IPO it in the US. You can fabricate fake revenues and profits, whatever it takes to make the stock price go up. The lack of regulatory oversight makes it likely that you can get away with the fraud for a few years before a short seller eventually exposes you. But by that time, you've already dumped most of your stocks and locked in your ill-gotten gains. Many of the businessmen who do this are politically connected within China, and they get away with little to no legal repercussions. For example, Luckin Coffee co-founder Charles Liu is a free man just 1 year after his coffee chain was exposed as a fraud. He is now trying his luck at a new noodle restaurant business. While only a small proportion of Chinese companies are fraudulent, investors don't have a good way of differentiating the real ones from the fake ones. This drags down the valuations and returns of the entire market. The third reason for low valuations in the Chinese stock market is the variable interest entity or VEI structure of US-listed Chinese stocks. China has strict regulations on foreign investment into the stock market. If you are not a Chinese citizen, it is illegal for you to own Chinese shares, unless you meet certain criteria, such as you are the founder of a company that IPO'd in China, or you work for a Chinese company and receive stock-based compensation. They restrict ownership because they don't want foreign investors to have undue influence on the operations of Chinese companies. The vast majority of people do not meet the criteria to buy Chinese stocks, but you can still buy shares of Alibaba and Baidu on your Robinhood account. So how is this possible? Well, Chinese companies get around the regulations by using variable interest entities or VEIs. The technicalities of how VEIs work are a bit complicated, so we'll look at an example. In 2014, Alibaba raised a record $25 billion when it IPO'd on the New York Stock Exchange. However, if you own a share of Alibaba stock, you don't directly own a stake in Alibaba's Chinese operations. You instead own a stake in a shell company registered in the Cayman Islands. The shell company is a variable interest entity. The VEI owns a contract which entitles it to all the profits from Alibaba's Chinese operations, so by owning a share in the shell company, you effectively own a share in Alibaba. The VEI structure is technically illegal under Chinese law, but the government has turned a blind eye on it for decades. Chinese companies have raised hundreds of billions of dollars through VEIs, and they have used this money to fund their expansion. Theoretically, if US-China relations worsen significantly, the Chinese government could declare all VEI structures illegal and void the ownership rights of all US-listed Chinese stocks, deeming them effectively worthless. This would amount to the biggest rug pull scam in history and would cost US and other international investors hundreds of billions of dollars. To be clear, you shouldn't go selling all of your Chinese stocks because this VEI structure exists. It's highly unlikely the government would actually do a rug pull and expropriate the ownership stake of foreign investors. The geopolitical ramifications and retaliations would far outweigh the benefits to China. But the bigger risk with VEIs is its impact on corporate governance and shareholder protection. One of the most egregious instances of bad corporate governance happened with Alibaba. Alibaba created an online payments processor called Alipay in the mid-2000s, which was meant to help facilitate transactions on their e-commerce platforms. In the beginning, Alipay was a fully owned subsidiary of Alibaba. In 2005, Yahoo bought a 40% stake in Alibaba. A large part of their investment thesis was the growth potential of Alipay. In 2011, Jack Ma spun off Alipay into a separate company called Ant Financial, which he controlled. He did this without the knowledge or consent of Yahoo, which made the transaction effectively a robbery. To understand how insane this is, it would be roughly the equivalent of Jeff Bezos spinning Amazon Web Services out of Amazon and giving himself 100% ownership. When Yahoo finally found out about this, they were understandably furious and tried to sue Jack Ma to get back their stake in Alipay. This is where the VEI structure comes into play. Yahoo did not own any stake in Alibaba itself. They owned a stake in the Cayman Islands shell company, which is technically not recognized under Chinese law. Because Yahoo's stake was not officially recognized, they were unsuccessful in their efforts to sue Ma and take back Alipay. Jack Ma eventually settled out of court and gave Alibaba a $6 billion consideration relating to the Alipay spinoff. But this was a mere pittance compared to Ant Financial's estimated $300 billion valuation today. The VEI structure makes it almost impossible for shareholders to defend their interests in court. And the recent crackdown on the education sector proves that the Communist Party doesn't really care about foreign investors. Investors lost tens of billions of dollars after the government proposed forcing education companies to become nonprofits. China's economy will likely continue to grow for decades to come. But historically, the economic growth has not translated to commensurate gains for the stock market. With the government getting even more aggressive about cracking down on private enterprise, the outlook for Chinese stocks going forward is more uncertain than ever. Alright guys, that wraps it up for this video. What do you think about the Chinese stock market? Let us know in the comments section below. If you enjoy this content, make sure to hit the like button and subscribe so you don't miss future uploads. As always, thank you for watching and we'll see you in the next one.